Welcome to the B.F. Anderson Technical Report for October the 14th. Earnings are critical. Over the last 18 months, roughly 5 quarters, negative earnings comparisons have been like a dark cloud over the market, and that's what's caused this poor performance in stocks really for the last 18 months, is that there's been so much uncertainty about what corporate earnings are going to be doing. Now, unfortunately, starting in 2014, earnings growth rates peaked and then started to deteriorate. So if you look at this graph, you can clearly see that, from 2014, 2015, then in the low of 2016, earnings look like they have troughed. Now, this quarter, earnings are expected to be down roughly 0.5%. So that's a really small number. It could go either way because analysts tend to underestimate just to be on the safe side. So the more important graph to notice to your right is revenue growth, which again you can see revenue growth troughing in 2015 and then starting improvement there, and it is estimated that third quarter revenue growth will go positive. So why is this important? It's important because when you invest in a company, what you're investing in is the balance sheet. And so with the balance sheet, you have the book value, which is assets minus liabilities. So how does a corporation increase the assets? Well, it comes from earnings. When a company makes earnings, that gets translated into retained earnings, and then retained earnings go onto the balance sheet as an asset. That way you increase the book value of the company, because when you buy a stock or invest in a stock, you are investing in that book value at that time. So if earnings are deteriorating, it means that book values are going down, not up. So if we can get a turn in revenue growth, which is looking like we're going to get, and a turn up in earnings, this could set the market up for a nice bull run. Let's hope for that. Now let's take a look at the charts real quick. This is, I wanted to kind of start out with the price of gold. Now, gold has dropped dramatically. I'll show another graph here shortly that shows what's happening currently. But, gold is a hedge against inflation. Gold is something that does well when people are worried about currencies being debased. Now, we have to realize the global debt is now $152 trillion. Now, are we going to pay this debt off anytime soon? No. Greece is not probably going to pay off, if ever. Now, the real question is, can these organizations, whether they're sovereign governments or whether they're corporations or individuals, can they continue to service the debt? Well, that's the worry here, and the worry is that if interest rates go up, that's going to make servicing debt more difficult, because at this point in the cycle, I think servicing debt will be critical. So, as you can see here, since the 07 debacle, the Great Recession, we've seen gold rally dramatically. Now, this is a fear asset. This is when people are fearful. Now, you can see that it looks like gold is topped. We've actually gotten a death cross in the price, and it has come down and is now what I would consider to be a downtrend. Now, let's just kind of talk about the S&P real quick here. You can see going all the way back even further, we have pretty much held in the 2100, 2120 area on the upper side of the S&P. Now, again, resistance can become support. Resistance can become support. Now, this drop right here coincides with the bad earnings quarter of first quarter 16. If you remember the graph that we looked at earlier, there is a definite correlation. So then again, we hit resistance, which now becomes support. Now, it has come down, hit that support level once. We retested it again this week. Hopefully it holds and we see a resumption in a year-end rally. Now, interest rates. Let's talk about interest rates real quickly here. This is the 10-year Treasury note. This is the 200-day moving average for the note. Now, there are investment strategies out there that benefit from this type of scenario where interest rates drop dramatically. what we would call a yield strategy, dividend yields. In other words, interest rates drop when there's a lot of fear. Bonds, things like that. These are all fear assets. Now, I think it is worth noting, and this is an old story and almost a cat of nine lives, we've come down to this level here again to around 1.3, 1.4 on the 10-year note. Now, we have rallied, and we are starting to see the signs of higher lows and higher highs on this yield. Now, the yield is currently at 1.75, 1.74. The 200-day moving average is 1.75, and actually it touched 1.8 last week. Now, here is the 2-year note, which is an important one to keep as well. Now, you can see interest rates do tend to be in somewhat of an uptrend, and I would say a breakout on the 2-year note above 1% would be meaningful. Again, back to gold real quick, this just to show you what's happened. We've seen a major breakdown in the price of the commodity, broke the 200-day moving average. This is a fear asset. Things are starting to change. Now, let's talk about something here that is important. This is a yield stock. This is a yield index or an ETF. It's called the IYR, which is a real estate investment trust type of security. Now, this group of stocks have done extremely well for the first half of this year. So think about it as an investor. You go, okay, I'm only going to go with what's doing well in the past. Well, if this group has benefited from lower rates and interest rates start to turn up, this group is going to crack. Well, that's what's happening. We're seeing a crack and a breakdown below the 10-week moving average for the real estate group. Now, there is a theory out there, and I do believe this theory, that when the fear stocks, which are the yield stocks, give up and break down and crack, that often coincides with the growth stocks taking a leadership position or the leadership baton. Let's look at another one. This is consumer staples. This would be things like soap, tobacco, things that are needed on an everyday basis. Again, we've got a dividend yield here. Those are mainly large cap stocks. Looks like they're starting to crack a little bit here. Now, the big one that's really done well this year is the electric utility group. Again, this is like a bond surrogate. It has rallied as interest rates have dropped. Now it's kind of breaking down. So we wonder if, what's going to happen with interest rates. Now, here's just one company I wanted to mention just to make a point. This is a company called Zeltic Aesthetics. And they have a heck of a story, and the projections are pretty much through the roof as to what this is going to do. But this is a technology where they have determined that if you freeze fat cells, that it kills the fat cells, and then the fat cells go out in your urine. So this is kind of a breakthrough in treatment of obesity and helping people control fat, because once you get fat on the body. But anyway, it's an interesting story, interesting numbers. The chart is interesting, but I want to emphasize something. Every Thursday we put out a watch list. And really, that is a watch list. It is not a buy list. It's just things that we're watching. Now, what am I watching about this company? The most important thing I'm watching is the amount of shares traded on a daily basis. Now, the average for the last 50 days has been about 775,000 shares a day. Now, at 1 million shares a day, this starts trading $40 million a day. Now, most institutional investors, meaning mutual funds, large pension plans, so forth, cannot get involved in stocks that trade as thinly as this simply because there's too much liquidity risk. If they want to get out of the stock, they can't get out of it. So the point I'm making here is that when you have a watch list, there are certain components that you're watching. You may want to watch the balance sheet. You might want to watch the income statement. But in this particular situation, the numbers are very good. The balance sheet is fine. I'm watching the amount of shares traded so that I want to time it in such a way that the institutions are starting to come into it. So in a nutshell and in conclusion, it looks like interest rates are starting to move up. The yield stocks are somewhat cracking. The S&P 500 has had a tough couple of weeks here, but we're thinking it's going to hold and possibly get a year-end rally. We'll see. Call me if you have any questions.